and the homework, I feel like.
Okay, some good feedback about.
Yes, the homework and the practices throughout the week, I think they really helped me to get the material down. It's I feel like it's just enough. Just speaking for me, it's just enough to for me to realize that I kind of got things under control.
Okay, that's really good to know. I appreciate that feedback. That's some of the best feedback I could get as far as understanding, especially since I just developed a bunch of courses following the same model. Okay, we are going to, oh, that's what I got up for my pen. We're going to review for the week 2 quiz. This one, I have a PowerPoint presentation. I'll post one that has all of the notes on it, in addition to posting the recording. But I put a blank copy in the course resources and also a link to them in an announcement. So you might want to just download them so that you have them. It might make it easier to keep track of what we're doing and write down the answers on it. So if you want those, that's there for you. Okay, so we're going to review questions that are very similar to every one of them on the quiz. And the nice thing about this is that we get to continue to review all of the pieces that we've learned, because by the end of this week, you are responsible for knowing the entire accounting equation. Okay. Question number 1. I'm sharing question number 1, right?
Yes.
Okay, good. All right, so question number 1. On July 1st, so I always go to the end and I try to figure out, like, what is it we're looking for? And so we want to know the insurance expense is what we're looking for. So on July 1st, a company paid the $6,000 premium on a 1-year insurance policy. So we know that we have prepaid insurance. What type of account is prepaid insurance?
That is an asset, right?
An asset. So that means that this is a debit balance. All right. And this was on July 1st. Now, we're looking for it at the end of the year. So one of the things I always say is that dates will, you think dates are easy, especially when we're dealing with months, but you would be surprised. So we're going from July 1 to December 31. How many months? Sorry, letting somebody in. How many months is that? July, so we've got July, August, September, October, November. That's what I mean. Now look, July, August, September, October, November, December.
It's the whole month.
It's 6. Right, because we're counting July because it's the 1st, and we're counting December because it's the end. But that's why I say that you will really find that you make mistakes. Go over here for the microphone. You'll really find that you make, that it's easy to make mistakes on dates. So be careful. All right, so we have 6 months that we've used this policy. The policy is a 1-year insurance policy. So if we have paid $6,000 and we have it for a year, then we're going to figure out that that is worth $500 a month. So our insurance expense would be $500 a month. We've used it for 6 months, which means that we've used up $3,000 worth. This $3,000 would go over here, it's used up, but we don't even need that because what does this $3,000 represent?
What we've used.
what we've used. And what we've used is our insurance expense. Does that make sense?
Yes.
So we have $3,000 worth of insurance expense. All right, are we good there?
Yes.
Okay, so number two. Number two, we are looking at what amount of insurance expense would appear on the company's income statement. So this is the same as question one. So on June 1st, a 2-year, so it's just for 2-year insurance policy was purchased for $154,800. So we know that to start off with, in our prepaid insurance account, we have $154,800, right? All right. Now we know that this $154,800 is for 24 months, 2 years. So that means that this is worth $6,450 a month. Now let's see how long we used it for. We went from June 1 to December 31. So June, July, August, September, October, November, December. So we have 7 months in this year. So if it's $6,450 per month, and we've used up 7 months worth, that means we've used up a total of $45,150. That would go here. So this is what we use, which makes this our insurance expense. Good there?
Yes.
Yes.
All right, now we're going to look at unearned revenue. So we're assuming that all of our adjusting entries are made at the year end, and we want to figure out the adjusting entry that we're going to make. So let's see what we're doing. Fragmental Company leased a portion of its store to another company for 8 months. Beginning on October 1st, at a monthly rate of $2,200 a month. Fragmental collected the entire $17,600 cash on October 1st and recorded it as unearned revenue. So we know we have unearned revenue. What type of account is unearned revenue?
Liability or asset?
It's a liability because we owe something. We're going to have to perform in the future.
Oh, yeah. Gotcha.
So we have unearned revenue of $17,600. And it's at a rate of $2,200 a month. So we have to go October 1st through December 31st. October, November, December, so 3 months. So by the end of the year, we've earned 3 months worth of the rent. So our monthly rate is $2,200. We've used 3 months or earned 3 months. So we're going to say 2,200 times 3 months, we've earned 6,600 of that rent. Okay, so what two accounts are affected?
Retained earnings and unearned revenue?
Okay, so retained earnings. Unearned revenue, yes. I think you got lost in closing entries. So we're going to reduce our unearned revenue because what did we do over those 3 months?
We earn rent.
We earned it. So this is actually, the other account is actually rental revenue.
Oh,
Does that make sense?
yes.
Because this is earned rent. So I can look up here at this T account and I can see I'm going to debit unearned revenue because I'm reducing a liability. And I'm going to credit rental revenue because I'm increasing my revenue by $6,600. So you're going to have to do the journal entry. Now, it'll be multiple choice, but let me tell you, it's a really good idea if you just work it out like this and then go look for the answer. You'll make fewer mistakes that way than looking at the answers and seeing if you can just see it. Are we good here?
Yes.
Christopher, you were here in the very beginning. I put these blank PowerPoint slides in the course resources and a link in the announcement, and I emailed the announcement. So if you want to like download them and print them or whatever to write on them, you can do that.
Okay, thank you.
I'll also post the filled out ones. Sometimes you can use like these to make sure you're ready by going through them. You don't need that though. Okay, so a company pays each of its 2 office employees. Okay, so I know we're going to do something with salaries. So we want to do the adjusting entry to record salaries earned but not yet paid. So we're going to do an adjusting entry for unearned salaries. Okay, so a company pays each of its 2 office employees each Friday. So we have 2 employees each Friday at the rate of $200 per day for a 5-day week that begins on Monday. If the accounting period ends on Wednesday and the employees work Monday, Tuesday, and Wednesday, that's what we haven't recorded yet. So we have 2 employees at $200 a day for 3 days. Monday, Tuesday, and Wednesday. So that's a total of $1,200 in wages. So now we just have to record the journal entry. So what 2 accounts are going to be affected?
It'd be salaries payable and then salary expense.
Yes. Did the payable increase or decrease?
Decreased.
What about the expense? Did the expense increase or decrease?
Increase.
It increased. What type of account is salaries payable?
Liability.
Mm-hmm. What type of account is salary expense?
Expense.
Mm-hmm. If I increase a liability, do I debit it or credit it? Credit. If I increase a liability, I'm going to credit it. If I increase an expense, do I debit it or credit it?
Credit.
So my journal entry is going to be a debit to salary expense and a credit to salaries payable for $1,200. All right, are we good there?
Yes.
Okay, this next one is something I have not shown you that I'm going to show you now. It's in the appendix to the chapter. Oh wait, this one doesn't have reversing entries. Sorry, I'm not there yet. Okay, so here we have an adjusting entry that was made on at the end of the year on December 31st to accrue salary expense of $4,000. So what we have is, this is what happened before. Before, we recorded the adjusting entry to record salaries that had been, salary expense that had been incurred but not paid. So we would have recorded salary expense and salary payable of $4,000 which means that we have in our salary payable account when we start the period, $4,000. Okay, that was the adjusting entry we did at the end of the year. Now where we are is, now we're going to pay the employees. So we're going to actually pay the employees $7,000 in January of the following year. And we want to know, what adjusting entry do we have to do? Okay, so here's what we think about. So what we've done is, they've worked for a period of time. $4,000 of that was an expense from the previous year. So we did a journal entry for it as an adjusting entry. $3,000 of it is the expense for January. So we're going to record. So we have three accounts. We have salary expense, and this is for January. We have to remove salary payable. For the previous year. And we're going to pay payroll, so we have cash going down. So did salary expense increase or decrease?
Increases.
It increased for January. Did salaries payable increase or decrease?
Decrease.
It's going to decrease because we're getting rid of the $4,000 that we said we owed when we did the adjusting entry. Is cash going to increase or decrease?
Decrease.
Yeah, because we're paying it. What type of account is salary expense?
Expense equity.
What type of account is salaries payable?
Liability.
Liability.
What type of account is cash?
Asset.
Yep. If I increase an expense, do I debit it or credit it?
You're going to debit it.
I'm going to debit it. If I decrease a liability, do I debit it or credit it?
Debit.
Mhm. And if I decrease an asset, do I debit it or credit it?
Credit.
Okay. So now we're going to piece together the amount. So I know that salary expense is the 7,000 minus the 4,000. So salary expense is $3,000. My salary payable is from up here. I have to make it go away because I'm paying it. So my salary payable is $4,000. And I'm going to reduce cash for the full payroll, $7,000. Does that make sense?
Yes.
Yeah.
Okay. Okay. Number 6, okay, we're going to do depreciation. A company purchased a new delivery van at a cost of $60,000 on July 1st. The delivery van is estimated to have a useful life of 5 years and a salvage value of $5,000. We use the straight line method, and we want to know what is the depreciation expense at the end of the year. So our formula is for straight line is the cost of the asset minus the salvage value divided by the life. So in this case, the asset costs $60,000. The salvage value is $5,000. And the life is 5 years. That means that we have depreciation expense of $11,000 a year. The problem is we don't have a full year. We have July 1 through December 31, or July, August, September, October, November, December. 6 months. So it's actually half of that. Or you could say $11,000 divided by 12 months means it's $916 a month times 6 months, $5,496. Which is just because of rounding. You wouldn't be wrong if you did 11,000 divided by 2, 5,500. Okay, are you good with how you calculate straight line depreciation?
So does it matter, like, so like if you just do like the depreciation, right, the 55,000, and I started off by dividing it straight by 60 months, because that's
You could do that.
but it comes out to 916.67. So that
Yeah,
would
if
throw it
I'd
off.
used 916.67, I would have reached 5,500.
Well, it comes out to 5,500.02.
Right. Yeah,
Yeah,
because
so like
rounding's
those
always
point,
going to do that.
yeah, those 2 cents, like Is it better to go with like just doing it by year and then breaking it down, or doing it by months? Like, because those 2 cents could.
Yeah, typically
Difference.
I'll do it by month when I'm looking for a monthly amount. You know, like if it's not a full year. Usually straight line depreciation, except for the first and the last year, will always be the same amount. So it's easier to calculate like a year instead of the month, because 2 years out of that, you'll be adding up the monthly amount, but all the rest of the years will be the full 11,000. That makes sense?
Yes. Okay.
Which is why I do it that way. Neither way is right or wrong.
Okay.
In fact, a lot of companies will record depreciation expense monthly. Some companies record it annually. And the reason they can get away with recording it annually is because it's a real expense, but you don't have to write a check for it. Like there's no cash implication. So, I mean, it is an expense. It does hit your income statement, but you know, that's different than having to write a check for it. All right, now we're going to look at prepaid insurance. We want to do the adjusting entry. So here's what we know. What is the proper adjusting entry at December 31st, the end of the accounting period, if the balance in the prepaid insurance account is $9,000 before adjustments? Okay, so I have in my prepaid insurance, which is an asset, so it has a normal balance of a debit. So I'm starting out with $9,000. And the unexpired, that's unused part, is $4,000. So at the end of the period, I have $4,000. How do I get from $9,000 to $4,000?
Minus the 5,000, which is the expense. Minus the 5,000, which is the expense.
Yeah. So the 5,000 is going to be a credit, and this represents insurance expense. So the adjusting entry is going to be, we're going to record insurance expense, and we're going to reduce prepaid insurance for $5,000. Are we good there?
Yes.
Okay. The next one's prepaid insurance also. The number 8 is also prepaid insurance. Yep. So we still want to know the adjusting entry. So Wilson Company paid $8,000 for a 4-month insurance premium in advance on November 1st. So we know that in prepaid insurance, we have $8,000 sitting here. Now it's for a 4-month policy. So if we say we have $8,000 divided by 4 months, that's $2,000 a month. And we're going November 1 to December 31, which is 2 months. So if we have $2,000 a month times 2 months, that means that we have $4,000 of used insurance. So this $4,000 goes here. And this is my insurance expense. So I'm going to make the same entry. I'm going to debit insurance expense, and I'm going to credit to reduce my prepaid insurance by $4,000.
What's that part about the 3,000? Says like the balance in the prepaid
Balance in the
insurance account
prepaid
before
insurance account before adjustment at the end of the year is 3,000. And no adjustments have been made previously.
So does that mean we
You
have,
know, I think I should have changed. I think when I changed the numbers, I might not have changed that one because we don't use it.
Yeah.
Because this
'Cause
would
that means that
actually be 8. Yeah,
Yeah.
I think I just didn't change it because you don't need it. And so I just, yeah.
Okay.
Oh, the next one's an example that we haven't done much of, but we've done the concept. So the next one, we're going to use prepaid revenue, but it's going to be subscriptions, like magazine subscriptions. Okay, so on April 1st, Santa Fe Inc. paid Griffin Publishing $4,500. So we paid $4,500 for a 36-month subscription to several different magazines. Santa Fe debited the prepayment to the prepaid subscriptions account. So we know that right now we have a prepaid subscription. And in this account, they have accumulated $4,500. So this was done on April 1st. Now, let's assume that they send the magazines out monthly. Well, we know this is for 36 months. So the first thing is we have April 1 through December 31, which is April, May, June, July, August, September, October, November, December. Yeah, 9 months. Okay, so if we have 9 months, and we have to calculate that. So if we had, we'll do it here. If we had $4,500 divided by 36 months, that is
125.
125 a month. Okay. This year we used 9 months worth times 125 a month means this year we've used $1,125. And all we're looking for is what amount would appear in the prepaid subscription. Okay, so we're not done because this is our subscription revenue. That's what we just calculated. But they didn't ask us for a subscription revenue. They asked us what amount is still in the prepaid subscription account. So to figure out what amount is still in the prepaid subscription account, we have to take away this 1,125, which was our subscription revenue.
It shouldn't be
And we
it should be that subscription expense, right? Because we're accounting for Santa Fe, not Griffith, right? We're the ones that paid for the subscription.
no, it's revenue for us. Santa Fe debited the prepayment. We're Santa Fe. Wait,
That's what I'm saying.
Yeah, we're
We
Santa
paid
Fe.
Griffith Publishing. So we paid the
Right.
expense.
right.
Yeah.
But,
Okay.
but we're looking at, oh, I see what you're saying.
It says like what appeared in the prepaid subscription account left over for Santa Fe, not
Yeah.
for Griffith Publishing.
Right.
Yep, because we're crediting the prepayment or the
Yeah.
payable or
So,
whatever.
so we started with the 4,500
Yeah.
that we originally paid. We've already gotten the magazines worth $1,125. So what we're looking for is what is the balance in the account. We still have $3,375 worth of magazines we're going to get.
Yep.
That makes sense?
Yep.
Tatiana, are you okay?
Yes.
Okay. All right. Now we're going to do the adjusting entry for accrued interest. So on December 1st, Milton Company borrowed $400,000 at 10% annual interest from the Tennessee National Bank. Interest is paid when the loan matures 1 year from the issue date. However, we have to record interest for December. So we just have 1 month that we have to deal with. So the first thing that we have to do is we have to remember how to calculate interest. So remember that's principal times rate times time. So we borrowed $400,000 at 10%, and it's for 1 year. So we have $40,000, and that's for the year. We need the amount per month, so 12 months. So the amount per month is $3,333. And this represents our interest expense. In our case, for December, but I mean, it'll be the same every single month. So we have our interest expense for December. We need to record that. So we're going to, what? So we're going to record interest expense, and what's the other account?
Interest payable.
Interest payable. Mm-hmm. Perfect. Are we good there?
Yes.
Okay, this next one is the one that we have not talked about or done. So I'm going to show you something new. Okay, this is called what happens when we use a reversing entry. And this is the way salaries is always handled in the real world. So the beginning starts out the same. Flag records adjusting entries at its December 31st year end. At December 31st, employees had earned $18,000 of unpaid and unrecorded salary. So here's what we're going to do. So at December 31st, our adjusting entry, right? We're going to record salary expense and salary payable for $18,000 because that was the expense that was incurred and hasn't been recorded yet for salaries in December. So what happens is we're sitting here now. Let's look at where we are. So we have salary expense with we start the next month with no salary expense. Hold on. And right now we have salary payable.
Yep.
18,000. Okay. Now, here is the new piece. We're going to do what's called a reversing entry. So on January 1, we're going to do a reversing entry. So basically, when you do your month-end close, you put this adjusting entry in. And then you go and you do this right away and you just date it January, so it takes effect the next year. And it's exactly what it sounds like. We're just going to reverse what we just did. And I'll show you why. It makes running payroll easier. Because when you run payroll, it automatically records everything as an expense. So instead of doing a journal entry when you run payroll the first time of the month, we're going to do this reversing entry. When we do this reversing entry, I have salary expense now starting out right here. Now, the odd thing about this salary expense is salary expense has a normal balance of what? A debit or a credit?
Debit.
A debit. A credit. It has a debit. Salary expense has a normal balance of a debit. But I have this $18,000 credit in here now, which right now on January 1st would look really weird.
Mm-hmm.
But here's what happens. When I run payroll now, when I run payroll on January 3rd, I'm paying $35,000. So when I run payroll on January 3rd, all I have to do is record it like normal. Which will happen automatically when I run payroll. So automatically, it will record salary expense and will reduce cash for $35,000. Okay, now you're thinking, but that's too much. Oh, I forgot something. No, I didn't. Yes, I did. Salary expense, 35,000. Oh, no, because I did that. Okay.
That's right.
So I just run payroll like normal. Now, what's happened was, forgot, when I did this entry up here,
Yeah.
I have zero balance in my salary payable account. But I'm sitting here on January 1st with $18,000 in my salary expense. That's a credit, not a debit. So when I record this $35,000 now, what happens is for the month, I have $17,000 balance, and this was the expense for January. And that's what will show up. So on my income statement, it'll say $17,000 for salary expense for January, and I will have no payable because it will have been paid by the cash. So the benefit of the reversing entry is that you can just very easily and quickly run payroll just like normal. All you have to do is just remember to stick the reversal in on January 1st, which in reality, you do them both at the same time because you do month-end close the week after the month closes. So, so you're doing this on like the 3rd or the 4th of the month. So you just do that adjusting entry real quick, just do the reversing entry, date it January 1st, and you're done. Then you just run payroll like normal and you don't have to think about it. All right, does this make sense? Okay. Closing entries using the income summary account. So I'm going to write down the steps. So step 1, close revenue. And remember, it's a good idea to look at a trial balance when you're doing this, to income summary. And then step 2, we're going to close expenses. Remember, close means make them 0, to income summary. Then 3, we're going to close income summary to retained earnings. And 4, we're going to close dividends to retained earnings. 4 steps. We good here? Okay. Okay, given a trial balance, calculate the current ratio. So the first challenge is that you have to be able to identify current assets and current liabilities. So if you can't do that, you will get the problem wrong. So you have to make sure that you can identify the current assets and the current liabilities. Because the way you calculate the current ratio is we take the current assets and you divide them by the current liabilities. All right, are we good there?
Yes.
This is the accounting equation and the equity, the beginning retained earnings plus revenue minus that formula. All right, it gets a little bit complicated because you have to calculate your beginning retained earnings using the accounting equation. So I already know that we're going to need the accounting equation. All right, so at the beginning of the year, Sigma Company's balance sheet reported total assets of $350,000, total liabilities of $30,000, and total paid in capital of $100,000. So what paid in capital is that's like stock or money that the owners put into the company. So remember, there's 2 parts of equity. There's the part that's contributed, and there's the retained earnings piece. This is the contributed piece. So we have contributed capital of $100,000, but we don't have retained earnings. We need retained earnings. That's what we're missing. So if we take 350,000 minus the 30,000, I guess I should write it out. If we take the 350,000 minus the 30,000 minus the 100,000, our retained earnings is 220,000. So that's the first thing you have to calculate. You need beginning retained earnings. Okay, now we need to figure out the retained earnings balance at the end of the year. Okay, so we have our formula, which is beginning retained earnings plus net income minus dividends equals ending retained earnings. Now, let's say we don't have net income. Instead of calculating it, we could add revenue and subtract expenses, right? All right, so let's see what we have. So we know we need our beginning retained earnings, which is $220,000. The company reported total revenues of $400,000. So we could just add that. And total expenses of $300,000. Also, dividends during the year totaled $80,000. So my ending retained earnings is $240,000. So that was two pieces. First, you calculate beginning retained earnings using the accounting equation, and then you use your retained earnings formula to calculate your ending retained earnings. Are you good? Okay. Are you done writing, Chris?
Mhm.
Okay. Yeah, it's much easier to do this when I can see you guys like this. I appreciate you turning your cameras on. Okay, now we want to do the closing entry for the revenue account. So I still think it's easier to look at like what revenue looks like, so that, because I'd look at a trial balance. So what I'm going to do for you is I'm going to put the revenue in a T account. Because what's the normal balance for revenue? A debit or a credit? Nope.
Debit.
Nope, credit. Revenue's a credit. So we're going to credit it $60,000. So that's what our revenue account looks like right now. Has a credit balance of $60,000 before any closing entries are made. Total revenues for the period are $70,000. And total expenses are $50,000. This is retained earnings. I'm like, what is wrong with my data? This is my retained earnings account. That's what's wrong with my data. The retained earnings account. Started with 60,000. All right, so if we're going to close these, the first thing we're going to do is we're going to close revenue to income summary. Okay, so revenue has a normal credit balance. So right now we're sitting here with revenue at $70,000 and we have expenses at 50,000, but they're various, and we're not closing them because we'd have to have all the detail. So here's our revenue at 70,000. What do I have to do to make revenue 0?
Debit 70,000.
Yep, debit at 70,000. So I'm going to debit revenue and credit income summary. For 70,000. So now my revenue account is 0. The second way of doing this is to not use the income summary account. The second way of doing this, depending on which you're looking at, is to close revenue to retained earnings directly. So then it'll be the same thing. We're still going to debit revenue to make it go away, but we'll put it directly into retained earnings. Okay, just closing entries, 2 different ways to close revenue. Are we good?
Yes.
Yeah, if you close the revenue like that, then like straight to retained earnings, that means you have to do it for expenses as well, right?
You always have to do expenses as well. Oh, you mean instead of, yeah, if you're
If you go
using the
directly to
income
retained
summary
earnings,
account,
Yeah, instead of
Yeah,
income
if
summary,
you-
you have to do expenses that way too. You can't pick and
yeah,
choose.
yeah. If you're using income summary, you're going to use it for both. If you're not using income summary, you're not going to use it for either.
Yep. Okay.
Totally correct. Because it wouldn't make any sense.
Otherwise, yeah, your retained earnings would show as 70,000 instead of 20,000.
Right. It wouldn't make any, yeah, it wouldn't make any sense. Okay, this is our retained earnings equation because what we want is the balance in the retained earnings account. So remember our formula, beginning retained earnings plus net income minus dividends equals ending retained earnings. Well, we have beginning retained earnings. So beginning retained earnings is 300,000. Net income is 60,000. Dividends are 20,000. This one couldn't be easier. And so our ending retained earnings is 340,000. It's just knowing the statement of retained earnings. All right, now we're going to do supplies expense. Again. So there's 2 different ways of giving you the information for supplies expense. One way is they tell you how much is left and you have to figure out how much was used. The other way is they tell you how much was used. So we know that we're dealing with supplies. So I'm just going to do my T account. All right, a physical count of supplies on hand at the end of May for Masters Inc. indicated 1,500 of supplies on hand. Okay, so we have to think because they just told us at the end of May. So what they just told us is at the end of May, we had $1,500 still left in supplies. The general balance before any adjustments is 2,000. So before adjustments, we had 2,000 in supplies. And we want to know what is the adjusting entry. So how do I get from 2,000 to 1,500?
And credit 500.
I'm going to credit 500. And this 500 is my supplies that I used or my supply expense. So my journal entry is just going to be supplies expense, and I'm going to reduce supplies. When I'm done doing this, my income statement will show an additional $500 expense for supplies, and my balance sheet will show a balance of $1,500 in supplies. Are we good there? Yeah? Okay. Unearned rent revenue. We want to know the unearned rent account balance. We don't even have to do a journal entry, just the account balance. So on October 1, Goodwill Company rented warehouse space to a tenant for $3,000 per month and received $15,000 for 5 months rent in advance. So they paid us money in advance for rent. So this is going to be our unearned rent revenue. And because it's a liability, we know that our balance is going to be a credit. So here's the $15,000 that we received for 5 months. Now, this is October 1st. We have to go through December 31, October, November, December. So we have 3 months to account for. They told us that it's $3,000 per month. So we can say $3,000 per month times 3 months is $9,000, and that's our used rent, or our earned, I should say our earned rent revenue. So this $9,000 goes here because we've earned that much of the 15. The question is, what is the balance in the unearned rent account? So what we're looking for is this number, which is obviously 6,000 is our balance. So you have to be really careful when you read these to make sure that you understand what the information is and specifically what they're asking you. Are we good here?
Yes.
We're close to done. Okay, 19. Rent revenue and rent receivable. Okay, so this had nothing in advance. So Sandboard Company rents space to a tenant for $4,000 a month, and the tenant currently owes November and December. So since they owe it, we haven't recorded it because we would have typically recorded it when they paid it. So the tenant has agreed to pay the November, December, and January rents in full on January 15th and agreed to not fall behind again. All we're concerned about is November and December. So we have November for $4,000 plus December for $4,000. So we have $8,000 of rent that we have earned. But we haven't received it yet. So I'm going to record rent receivable and rent revenue for $8,000. Okay, how do you feel about that? Are you okay, or are you confused with it?
I'm okay with it, but do we need to also record the half of January that is still due?
No, well, we will in January.
So wouldn't
On
be,
January, he's actually going to pay us, but we haven't. All we're dealing with right now is the
okay,
adjusting entry on December 31st.
gotcha.
So yeah, in January, we'll reduce the rent receivable and we'll record the rent revenue for 1 month.
I see.
But we don't have to think about that yet. Okay. All right, this next one. You have to, you're given a worksheet for the current period, and you have to calculate net income. So you have to be able to identify revenue and expenses. Because net income is obviously revenue minus expenses equals net income. So the biggest thing here is you have to be able to identify what are the revenue account and what are the expense account. This is just how do we close the dividends account. So we know that we're going to close dividends to retained earnings. But let's look at what it looks like in the T account, or if I were you, I'd look at a trial balance. For the year ended December 31st, a company had revenue of $400,000 and expenses of $200,000. They don't matter here. We're only concerned about closing dividends. The company paid $60,000 in dividends during the year. The balance in the retained earnings account before closing is $100,000. We also don't need that. So we paid dividends of $60,000. Dividends has a normal credit, a normal debit balance. So we're sitting here right now with dividends of $60,000. What do I have to do to make dividends zero?
Credit 60.
Mm-hmm. So I'm going to debit retained earnings and credit dividends, which makes sense because dividends reduce retained earnings for $60,000. Are we good there?
Yes.
Okay, this next one we've talked about. Well, we've talked about all of these. So this next one, we're just figuring out the source of cash flows under investing. So you want to start to think like, what does investing have to do with anything? A machine with the cost of $200,000 and accumulated depreciation of $100,000 is sold for $60,000 cash. We are only concerned with cash on the cash flow statement. Nothing else goes on the face of the cash flow statement. So this is the only thing that matters. So we increased cash $60,000 in investing. I don't have anything written on this next one. I have to figure out what I did. Account for Huckleberry Company is preparing the company statement of cash flows, cash dividends, beginning retained earnings, and net income. I don't know what I did here because I left something off, but cash dividends has to do with financing. Net income has to do with operating. We want to calculate the cash received from the dividend. So this is a slightly new way of thinking for you guys. So if I had dividend revenue of $40,000, let's look at my dividends receivable. So I know that I have revenue of $40,000, but we want to figure out how much cash we've received from dividends. So if my dividend receivable in the beginning was $5,000 and my ending receivable is $8,000, the difference is $3,000. This $3,000 represents cash not paid for dividends, or in our case, received for dividends. Instead, it went into the receivable. It increased the receivable. So I did not receive this $3,000 in cash. It's still owed as part of the receivable. So the cash itself was only $37,000. Because the other $3,000 increased my receivables. That's where it's living. Are we good with that? Last but not least, okay, so we're not going to say true or false. I'm going to show you this. So if we have revenue, we're looking at closing entries, and we have expenses. The normal balance and expense is a credit, revenue. The normal balance in an expense is a debit. Okay, so here's my income summary account. If I close revenue, I'm going to debit revenue and I'm going to credit income summary. So in my income summary account, revenue ends up on the credit side. If I got rid of my expenses, I'm going to credit them. So I have to debit income summary. So expenses go there. So if I have a balance on my credit side, I have net income. If I have a balance on this side, I have a net loss. Does that make sense? And that's it. Okay, how do you feel? Next week, we start rocking and rolling. After you take the quizzes, you can look at the paper and see what you're thinking about that. I would say that I'm having problems. I don't understand why people aren't responding to the discussions, but my guess is that the people that are here are the ones that have been responding to the discussions. However, your first post of the week is due on Wednesday, and there's only 2 in there today, which is making it really difficult for those 2 to respond to somebody, because they only have one option. If they don't like that, they only have one option. So if you guys would go in and post to the discussions, that would be awesome.
So they're not,
Okay.
they're not due by Friday.
The course outline says Wednesday. Oh, the first week we just did it later because we started late. That
Okay.
explains it. I knew, it's like I said, I was talking to, I think, Christopher earlier, and I said, it's my fault. I don't know what I said or didn't say, but it had to be my fault or this many people wouldn't have done it. It had to have been a miscommunication on my part. So if you go in and do that, that would be great. This is what the quiz will look like. One person here has already taken it. Would you say that this is what the quiz looks like? Yeah, see, this is what the quiz looks like. So it's right here. You're completely equipped to go do it. Call me if you have questions. Text me. I'm trying to not answer my phone because every time I answer my phone, it's one of those loan forgiveness things. And they're calling me literally like 30 times a day. And somehow they're spoofing other people's phone numbers because it doesn't come across as spam. It'll come across as like somebody's name. And 2 of them I've called back thinking they were students. And they're like, I haven't made any phone calls. So text me and I'll call you right back. So reach out if you have questions. Reach out if you have problems with the homework. And other than that, you should be done with everything for week 1 and week 2. Oh, that's right. Thank you for reminding me, Maurice. Oh, so Christopher just did a GroupMe join address for study group. So I would, if I were you, I would copy and paste that from the chat and I would throw it on a Word doc on your desktop so you have it, because the chat goes away. Although here's what I'm going to do if he doesn't mind. Do this whole thing here. There you go. So at least it'll still be there if you want to go back. Yeah, I saw that, Marika, because both of you were the only 2 that had done it. There is somebody else there now, but that's what he was saying as well. Okay, so GroupMe link if anyone else wants to use it so we can do study groups. Perfect. I'm going to have to try that. I've never used GroupMe. Okay. If I were you, you might want to like take a picture of that, because then you don't even have to go back and look through the end of the recording. You just have a picture of it on your phone, which makes it where it's easier to like get together. Okay. Other than that, would it be helpful if we did a phone list or something?
I like having the phone list because it's easier to just like text people when you need to talk about something.
I'll start a I'll ask everybody for their phone numbers, but if you guys will text me your name just text me your name tomorrow and I'll know that's why. And I'll put together a phone list from us and send it. You don't have to say anything else but your name because your phone number will obviously come through. And I'll put that together tomorrow and send it out to you guys also. And then
just
I'll
so you
invite
know,
anybody else to add to it.
That GroupMe app is an app you can use on your phone.
Oh,
It just
nice.
makes it easier so you can silence it. So like if you're inaccessible, you do that. That way you're not, because like even if you get a text message, if you like delete it and someone texts you again, it's not like a constant bombardment. So like I've just used it in the past couple classes. So it becomes pretty
Okay.
useful when you're like, hey, I have a question about this. Anyone know how to explain it, or how do you cite this source or whatnot?
Oh, I see. So you can like pretty much, okay. Oh, I see. I'm going to follow my advice to you guys.
Yeah,
Well,
I
And
just
I'll play with that tomorrow too.
I
we just
just
used to share like those links for like Google Docs for your papers. So you can
Yeah.
get people to actually
Okay.
review it for grammatical errors or whatnot, or make suggestions.
Yeah, it's a really good thing to team up together. Working with other people is a good thing. Tim already did it. Thank you. Okay, so I will put that together tomorrow morning. Sound good?
Yes.
That's a good idea. And that'll carry over to the next class too. So that's a really good idea. Okay, I will see you on Tuesday. Take the quizzes, and I appreciate you coming. All right, good night, you guys. I'm going to stop sharing. Good night, you guys.